A few days ago, I asked you for your controversial crypto opinions. So in today's show, I'm going to be going through 14 opinions that I've taken from the community and reacting to them. Some of them are pretty crazy. Some people are calling for 6K Bitcoin. There's many opinions on crypto being a massive Ponzi scheme. Some people say Ethereum's better than Bitcoin. That many tokens in the market are useless. We're going to go through all of the controversial opinions, and there's lots of them, and some of them are pretty nuts. And we're also going to go through the charts because we did have a big Bitcoin breakout this morning, and I do want to open a trade live on the show today for the gains trading competition. So I have actually put in an order, and it looks very, very, very close to hitting. So what I'm going to do is I'm going to go through a few of the controversial opinions first, and then we're going to get into that trade in just a few minutes and get straight into it. So yeah, without further ado, let's get to the first controversial opinion, and that is that crypto companies can still go public, which means that their tokens will eventually go to zero and that tokens do not equal shares. Now, I would kind of agree with this in one respect, and that is the respect that many tokens don't do a great job of capturing the profitability of the underlying business. So many tokens are kind of very forced and unnecessary in some cases. So you do have some chains where the chain can exist without a token. We've seen the Arbitrum network, for example, succeed without a token. We see many DEXs and centralized exchanges implement tokens when they're not really needed, when the underlying basis of the platform is simply to offer a service, for example, trading. However, in some cases, a token can be very beneficial. And the reason token exists is to kind of divide the company up to give it the ability for people to actually own shares in that company via receiving revenue, and also have governance over the protocol so you can decentralize a protocol. Because if you don't have a token, then you can often end up in a situation where you have a centralized entity controlling everything about that protocol. Whereas if you do have a token, you can spread the governance voting rights across all the token holders, and eventually that can lead to more decentralization. So I do agree that a lot of crypto companies don't do a great job at accruing value, but tokens that do have direct revenue sharing mechanisms, do have direct inbuilt governance mechanisms into the protocol via staking and via voting, I think at the end of the day, that does equal a form of ownership. And it's basically the exact same thing that stocks do when they share dividends with their shareholders. So revenue in crypto equals ownership, just like ownership in the stock market is represented via a dividend. So I agree with this, and I also disagree with it at the same time. Going into controversial opinion number 2, 𝗕𝗏𝗫 says that the app chain thesis is flawed. And this is quite an interesting opinion. The app chain thesis is something that's been proved, or at least gone to market with, by the 𝗕𝗏𝗂 ecosystem. And what this thesis kind of outlines is that every protocol built on the blockchain that wants to scale will seek to deploy their own sovereign chain that gives them full control over their protocol without relying on an inherent L1. So the app chain thesis is basically that protocols are better off having their own chain that is maybe secured by a network like, for example, the Cosmos hub. But at the end of the day, they have their own chain where they can kind of keep sovereignty and control over what they do with that chain. And I think the benefits to this is that they can maintain their own consensus mechanism. There's a bit more flexibility to do what they want with that chain. It can be more secure, especially if you're kind of leveraging into chain security, and it also can increase uptime. For example, if you're building on Solana and the network's constantly going down, you don't really have control as a Solana dApp over what's happening to the Solana network itself. But if you're an app chain and you're leveraging the security of the Solana network, but you're kind of running your own consensus, then as long as your consensus doesn't go down, your app can still operate because you're on your own chain. So there's definitely strengths for the app chain thesis, obviously sovereignty, interoperability, more room for speculation, and also further token utility, because obviously the token itself can operate as the integral token of that ecosystem, the gas token of that ecosystem, which means that token can accrue more value if you are on your own app chain versus, let's say, an app is utilizing the Ethereum network. All the gas fees are going to be paid in Ethereum. It's not as beneficial for the token itself. So there are some benefits, and that's why the app chain thesis exists. But the argument being made here is that the app chain thesis is flawed. And these are some of the reasons against the app chain thesis in kind of aligning with what 𝗕𝗏𝗫 said here. That's firstly the lack of composability. So essentially what happens is applications isolate themselves because they fragment liquidity. So they fragment from the base chain itself, whether that's Ethereum, Solana, and in this case, Cosmos, and they fragment liquidity into their own app chain. And that does certainly have an impact on composability. Now, it's not necessarily a problem because the ecosystem could still work well, but it's sometimes this creates security issues, and sometimes this creates issues related to the user experience. So that's one of the reasons why fragmented liquidity can be a detriment to a protocol. Also, it can create security issues. Just as it can be a plus for security, it can also be a negative, being your own app chain, because sometimes, for example, the Cosmos SDK can be clunkier to build on than the EVM, and applications therefore become responsible for their own security. So if their team doesn't do a good job, or their developers don't do a good job at making the network secure, then you kind of do run the risk of potentially having inherent flaws in your chain, and also cannibalization within the ecosystem. So this is essentially where the base chain, for example, Cosmos in this case, doesn't accrue value as well as the app chain, because it's not the gas token, it's not the integral token, and it makes value accrual much harder for the base chain. And I do think we've kind of seen this with Cosmos. It probably doesn't accrue value as well as some of the other chains in the market do, because of its app chains utilizing their own tokens. And obviously there's pluses and negatives to this, but at the end of the day, the Atom token that relies more so off airdrops, and I know they have new tokenomics, which has improved the tokenomics of Cosmos, probably still isn't strong as some of the other chains in the market. So there is pluses, there is negatives, but at the end of the day, I don't think it's flawed. I just think there's positives and negatives. And at the end of the day, it's all about user experience. So it's about the user getting an end experience that is better no matter what technology they use to achieve that. And if the user can get a better experience on an app chain, then we should use app chains. If the user gets a better experience on an L1, then we should use L1s. At the end of the day, you shouldn't even know you're using DeFi. You shouldn't even know you're in crypto. All you should be able to do is perform the base function of that dApp. If that's a game, that's playing a game. If that's a DeFi protocol, that might be swapping tokens or borrowing or lending a token. It's all about user experience, and however we get there is however we get there. But certainly, the year 2022 was the year of the app chain thesis. It was kind of the year of Cosmos in many ways as the ecosystem grew, and I'm excited to see how this develops. I do envision a future where we kind of have our own kind of proprietary L1s, all working in their own ecosystem. And then you have protocols that utilize app chains all working in their own ecosystem. It's kind of what Avalanche is trying to do through its subnets as well, and Polygon with supernets. And they're all interoperable and working with each other. That's kind of where I see the future headed. All right, so before we get into controversy number 3, we have to talk about trades right now, because my buy order, my long order, is just about to hit. And I want to place it, or at least show you the trade live on the show. So basically what happened overnight with the Bitcoin price is that it broke out of our range. So you guys know we kind of had a range set here. We've been shorting for the last couple of days. Every time we hit the top of this range, and every time we've hit the bottom of this range, we have been longing. And that gave us 3 opportunities to long, and 1, 2, 3 opportunities to short that were profitable. But we actually did break out of this range finally. And what this meant is that we hit almost 24K. So we broke to the upside, showed quite a lot of strength on the 1 hourly, but on the 4 hourly, we didn't really have a chance to actually confirm above this level. So right now, we still don't have confirmation on the higher timeframes of a breakout. But if we look at the 1 hourly chart, it's certain that a breakout is happening. And it kind of, if you draw the diagonal trend, almost looks like the breakout of a flag. If you draw the top line in there, the bottom line in here, they're not perfect lines, but just to give you a rough idea of the current setup for Bitcoin, we did have a breakout and then we had a successful retest. So for me, it's very risky to go short right now. And although part of me is tempted to abide by the range and have another go shorting because it was successful 2 times in the past and we did well off those trades, I just can't really do it again right now, because the market has momentum, and you always have to trade with market momentum. If you're going against the market, more often than not, you're going to get wrecked. And right now, because we did have such a strong break above, and that would require us to set a stop so far ahead of the current price, it just becomes very risky to open any kind of short at this level, although part of me wants to. So what I'm doing instead is I'm just going to ride the momentum. I'm going to go with the trend here, and I'm going to open a trade at the 23K Bitcoin level, because this is a level where I can set quite a tight stop. So the problem with shorting here is that if you short, you have to set a stop all the way up here. And that's roughly like a 30% stop. And basically that's just too much room for the price to move and too much room to get wrecked. Whereas if you decide to long here and go with the trend on the 1 hourly, which admittedly is quite bullish, then you can kind of open a long in this zone, and then you can set your stop below the previous wick, which is a much better trade because you're only risking 10 to 15% depending on how much leverage you're using. So I'm going to open a trade on at 23K for this region. And that would be a higher high on the 1 hourly and then on the 4 hourly as well. Hopefully what this means is we can eventually retest and hold above this level and then look for a breakout on the higher timeframes as well. So the reason I'm doing this today is because Gains Network just started their trading competition, which they're giving away $100,000 in prizes. And there's actually 2 prize pools. First prize pool is for absolute P&L. So that's dollar P&L. So the person that makes the most dollars gets to win $20,000 in first place, $10,000 in second place, and so on and so forth. But then there's also an identical prize pool of another $50,000, which is being given away to percentage P&L. So this means you can trade with any amount of money you like above the minimum, and essentially just the winner based on percentage ends up winning the prize pool. So for me, that's probably the prize pool I'll be going for. Because I'm pretty sure I'll get out traded by some whale that's trading like with $1 million. For me, I'm putting like in around $5,000 into this challenge. I might put more later on, but let's just see how it goes. So yeah, big prizes up for grabs on Gains Network. So what I did is I put in my trade. You can see here my open order. I'll just zoom in a little bit so you can see it better. It's a Bitcoin long because Bitcoin has the relative strength right now. One way to kind of gauge this is how far Bitcoin broke out. Based on this 1 hourly candle, which was to its peak 3.8%. Ethereum did not break out as heavily as Bitcoin. It only broke out 3.6%. So similar, but Bitcoin still has the strength. And we can also see this with the Bitcoin dominance, which is in an uptrend. So when dominance is in an uptrend, that's a sign to me to long Bitcoin instead of longing alts, just at least in the short term. That's kind of why I'm longing Bitcoin also. It's my first trade of the comp. I don't want to go too degen and wreck myself on the first day. So I am opening a Bitcoin long. It's at 23.10, just in case my order doesn't get filled. Then my stop loss is at 22,700. And the reason why it's at this level is because I want to put it under the previous wick. I want to give myself a little bit of breathing room. So I put it in at this level here. It means if I get stopped out, I only lose 13%. So I'm putting $750 at 10x leverage because the minimum 7,500 DAI total position size. And that will essentially mean if I get stopped out, I only lose roughly $90. So it's not a huge loss if I lose 90 out of 5,000. However, it still gives me some skin in the game to take advantage of a potential uptrend. So if you do want to trade in the Gains trading competition where you can win some pretty massive prizes, I mean, $100,000 up for grabs, you can trade using the link in the description. Beware, there is a minimum that you need for position sizes. You have to trade on the Arbitrum network, which means the minimum is 7,500 position size. That doesn't mean outlay. So you can do a $750 trade like me on 10x leverage. You can do a $300 trade on 20x leverage. It just depends how you want to trade, how much risk you want to take with how much leverage you're using. But just beware there is a minimum. So you need some decent cash to take part. If you only trade small position sizes like 100 or 200, you're probably better off looking for another exchange like Apex. But if you want to take part in the comp and you do fancy your chances, or just want to have a bit of fun and learn alongside me, then you could do so in the Gains comp. So once again, link in the description to trade in the Gains competition. Click this link, and as soon as you deposit DAI into your wallet, you will be eligible for the trading competition. There's no sign up. It's not like Bybit where you need to sign up and register. All you need to do is use the link in the description, and you can get trading as long as you have DAI in your wallet. So that's my first trade. Let's see how that pans out. I'll keep you updated on every show. And there's also a nice leaderboard here. We can see the leader right now is in a lot of profit. I just want to refresh here and see who's actually winning. Relative P&L, so based on percentage, someone's already made 3,000%. I don't know how, but the top 10 is 194% right now. So that's not too bad. I mean, it's only day one of the comp. Usually what happens is people make a lot in the first few days, and then they tend to wreck themselves as they keep kind of trading and taking on more and more risk. So it'll be interesting to see where we end up finishing. Hopefully I can finish above Kyle and Sheldon. That's my goal. If I can beat them, then that's a mission success. But, I'm just having some fun trading, not taking it too seriously, but also, trying to test my skills in real time. And if I lose money, I lose money. If I make money, I make money. That's cool. I'm doing it with a percentage of my portfolio I'm willing to risk. And the trade I took just then, it isn't a massive one. It's more just kind of a momentum trade with a relatively tight stop loss. So I only lose $90 if it loses. But if I win, if we do have price targets of 24,000, we got price targets of 25,000 if the Bitcoin continues its upwards push. And that would mean a double my money scenario where I can win $700. So upside versus downside risk is in our favor to the long side as long as the trend is bullish. So if we can confirm that breakout, then that would be quite good. So yeah, that is what I'm doing in the trading comp. Let's get on with the rest of the controversial opinions. Now, the next controversial opinion I want to talk about is actually a very interesting talking point, and it probably almost deserves its own show in many ways, and that's that noobs love centralized exchanges. And although a lot of the really dedicated crypto community post FTX really doesn't like centralized exchanges, 𝗕𝗏𝗏𝗏𝗏 says the centralized exchanges that survive this bear market will do very well during the upcoming bull market. And tokens like CRO, which is Crypto.com, BNB, which is Binance, KCS, which is KuCoin, will 8 to 12x depending on their market cap. So he thinks that because noobs love centralized exchanges, he thinks that they're going to do very well in the upcoming bull market. And you know what? I would agree with this controversial opinion. I think he's spot on. And I think I'd add OKX, so OKB, into that conversation as well. Here is the thing, though. It totally depends on your ethics, because some people, Ran included, don't invest in centralized products simply because they're in crypto for one reason. That is to support decentralization. That is to work towards a new economy. And that basically invalidates any centralized trade. So Ran likes how he has a framework for how he invests. He invests in great decentralized protocols that are solving a use case and are working towards a decentralized future. And I 100% respect that. But from a money-making perspective, if you don't have that framework and if you don't have those morals and your goal is simply to make money in crypto, then maybe we do consider getting into the centralized exchanges that are going to survive and are going to be around. Because one thing's for certain, next cycle, when retail floods back into the market and when the market gets overheated again, you're going to need on-ramps. And I just can't anticipate within the next couple of years DeFi on-ramps getting to the point where centralized exchanges aren't needed. I would go so far as to say centralized exchanges will always be needed, and therefore there will always be opportunities in this niche. So then it's just up to finding those opportunities. Now, I like BNB as a token. There's a lot of FUD around it. So whenever those FUD events happen, I use that as an opportunity to stack. It's worked out quite well in recent times because there's been a lot of FUD, and that's given us a lot of opportunity to accumulate, especially this major dip we had in December. This was a great buying zone, the 200 to 250 buying zone. And I'm sure we're going to get more Binance FUD because people love to FUD the top dog. But then you also have exchanges like KuCoin that they have a lot of FUD around them, but they never go down. So although KuCoin certainly has its doubters, time and time again, it's been quite resilient. And time again, it stood up against those doubts. And the more it could do that, and the longer it can kind of put in this track record of being resilient, the more confident I get in it as an exchange. And as a token itself, it could be a decent play as well. And then, yes, CRO is another one, Crypto.com. And you've got other ones like OKB as well. I think OKB is kind of looking inflated market cap-wise. But in terms of what they're doing as a new exchange, it's quite good in my opinion. So there is opportunities in the centralized space. Maybe I do a future video on this looking into the tokenomics, because the issue with centralized tokenomics is that it's basically at the behest of the company that's running the token. So BNB can choose how much value they give the token. They can also choose to remove value. Of course, it's in their best interest to give it value though. But it's a bit different to a DEX where you might have a more linear kind of revenue sharing model that is much easier to kind of digest how it operates. It's kind of a bit more murky when it comes to centralized exchanges, and that we obviously had an example of that with FTT. So you do have to approach it with caution, but I do agree. I actually do agree with him that we're going to see some centralized exchanges perform very well for next cycle. The next opinion is the world only needs two cryptos, Bitcoin and Ethereum. Now, I will just flat out disagree with this opinion, because I think although Bitcoin and ETH are great base layers, they only serve that fundamental purpose. That is what they are. They're base layers. So Bitcoin and Ethereum are a little bit different. Bitcoin is solving that monetary need, and I'll talk about that in a second with one of these other controversial opinions. Bitcoin is solving that need as hard money, sound money, kind of a gold replacement in many ways, or a better version of gold, essentially, digital gold. And then you have Ethereum, which is more of a network where you can build dApps on top of it. Can create use cases on top of it, and it kind of powers a decentralized ecosystem. So they are different, but at their very core, they're both base layers. One is a base layer for the future of money or gold, and one is the base layer for a decentralized internet. And the thing about base layers is the layers themselves, maybe for Bitcoin it's a little bit different to ETH, but at least in Ethereum's case, aren't necessarily what makes them so special. It's the dApps built on top of them that makes them special. So what about all the use cases that can be built on top of Ethereum? The environmental use case, the supply chain use cases to increase supply chain efficiency for businesses, entertainment like gaming, like actually things that people can do and use on chain. They can play games, they can watch movies and earn money for watching movies. The monetization of media, DeFi economies, so borrowing, lending, so many DeFi use cases which are necessary. And then also the ownership aspect, NFTs that can represent identity on chain, ownership of your own assets in the digital form. These are layers that are in and of themselves actually not that special. What is special, especially for L1s, is what is built on top of them. So at the end of the day, we don't just need the two cryptos, Bitcoin and Ethereum. We need those apps that are built on top of them and harness the underlying layers themselves and create use cases and create real world needs and real world utility on top of them. And as I said, more relevant for Ethereum than Bitcoin, although we do see some things being built on top of Bitcoin. But in general, we don't just need Bitcoin and Ethereum. We need all these other things to work towards the future that we're trying to work towards. And yeah, Bitcoin and Ethereum just won't cut it from that respect. And that's why we're very interested in altcoins on the channel, because we believe that the ones that change the world, they are the ones that are going to exhibit the strongest gains and give you the most upside potential in the market, more so than Bitcoin and Ethereum. All right, talking about Ethereum in probably a bullish sense, we totally flip with this next opinion to the bearish sense, and that is that Ethereum is centralized and censored. JP Morgan run Consensus, the largest developer on ETH, and overall, Ethereum's a very centralized network. In fact, I've even called some people, I've even seen some people in the comments on this thread call Ethereum centralized garbage. So how centralized is the Ethereum network? Well, honestly, relatively centralized. That might be a shock to some of you. It might not be a shock to some of you, but Ethereum is relatively centralized. And the way we can kind of work out how centralized a network is by looking at the distribution of stakers to the validator nodes. And if we look at the distribution, Lido takes up 25%, Coinbase takes up 12%, Kraken takes up 7%, and we have unknown, so various validators taking up 30%. And the Ethereum Foundation also takes up a large percentage as well. And there is a large amount of staking depositors by centralized exchanges like Coinbase, Kraken, Binance, Huobi. Coinbase itself's deposited 2 million ETH, Kraken's deposited 1 million ETH, Binance has deposited 1 million ETH. And in terms of liquid staking, you have an 87% dominance from Lido, which overall owns 29% now of the total ETH beacon chain deposits, Coinbase 12.67%. So if we use that to work out Nakamoto coefficient, which is a measure of decentralization, Ethereum comes in around at a coefficient of 4, which is relatively decentralized. Relatively centralized. Now, is that something to worry about? Maybe in the short term, yes. But the thing you have to remember about decentralization is that we're not at the point of decentralization yet. Crypto has an ideology, and the ideology it has is to be a decentralized economy in the future that's permissionless, immutable, and isn't owned by one central authority. But the problem with this vision is, to get there, you need to start somewhere else. You need to start centralized to become decentralized, or you're not going to get the adoption necessary. You're not going to get the flexibility necessary to upgrade and improve upon the network, and you aren't going to create real network effect. For example, if Ethereum launched completely decentralized on day one, would they have been able to complete the merge? Probably not. If Ethereum launched completely decentralized on day one, would they be able to continuously upgrade the network? Probably not. And would they be able to get the adoption required? Probably not, because the rewards on staking will be much, much, much less. And staking rewards are a major incentive to get people on a network and using a network. So at the end of the day, although Ethereum is relatively, and I say relative because we have to compare to what our idea of decentralization is, which is that we have an economy that's spread across thousands of validators with no particular party owning, let's say, more than 5%. That's kind of your definition of decentralization. Then ETH is fairly centralized. But long term, it will become less and less and less and less centralized. And eventually it will become decentralized, in my opinion. And that's where we're working towards. But we kind of have to get out of this mindset of calling things decentralized and calling things centralized right now, when we know that that's not how crypto works, and we know we're working towards decentralization. And that's going to take time. And we've seen improvements across many chains in this respect. And I think Ethereum fits into a similar basket as that. This is now the thumbnail of the video, which is crypto is a Ponzi scheme. And this person says, most crypto utility is a house of cards. It's a Ponzi until real utility tokens form the basis for them to thrive on. Now, the word Ponzi scheme is chucked around a lot in crypto. The first thing I would say is it's probably overused, and that most cryptos aren't Ponzi schemes. Although in the past there have been crypto schemes that have been pyramid-esque or Ponzi-esque, like some of the centralized parties, for example, BitConnect, for example, kind of had Ponzi-esque tokenomics and ended up being scams. And we also had crypto projects which kind of were pyramid schemes in many ways that relied on deposits, and those deposits were used to pay out new stakers to kind of incentivize people to use the chain. Sorry to all the Hexians out there, but Hex is an example of something that I would consider having Ponzi-esque tokenomics. The reason I say Ponzi-esque is because Ponzi scheme implies some sort of illicit, ill intent to scam or deceive. And I don't necessarily think many cryptos had that intent to scam or deceive, but they were built on a fragile mechanism. And fragile mechanisms that relied on a liquidity influx to prop up a price or prop up a narrative, which would eventually implode when liquidity exited the ecosystem. And that's what happened in the bull run. You had many chains incentivizing people to come on with super high emissions and protocols that paid out based on liquidity coming in. But then what happened is once the macro flipped and once the market became more risk off and interest rates went up, so there was more opportunities outside of crypto to get yield, a lot of these yield protocols started getting less deposits, which resulted in less yield, which resulted in less deposits, and the house of cards obviously collapses in the end. So you have to do your best job. You have to do your due diligence to work out whenever you invest in a project, where that yield is coming from, especially in DeFi. Is that yield coming from the revenue being generated by the protocol, like something like a gains network, or is the revenue being generated by the protocol fake revenue from emissions and or relies on a continuous influx of liquidity? Now, most crypto projects do rely on liquidity coming in. That's just how markets work. Markets need support, and support comes in the form of liquidity. So I guess you could argue all of crypto is a Ponzi scheme if that's your metric. But I think the important distinguishment to make is that Ponzi is an illicit attempt to deceive, and what I would describe crypto as is a market. And markets do have pyramid-esque underlying mechanics, and it's our job to use them to our advantage and get into projects where you can benefit from that and get out of projects where you think that's going to be a detriment. So it's really working out the cause and effect of a project's tokenomics every time we invest in a project, and we can actually benefit from this. So yes, many cryptos are a house of cards. Yes, I still think 99% of altcoins today that you see in the market are going to inevitably go to zero. I think that's just how it is. I think many projects don't really have much utility, and many of the top 100 don't have much utility, but it's our job to identify the ones that do and the ones that we can think we can make money on. And at the end of the day, that's all we can do as investors. We just got to do our best in that respect. Next controversial opinion. Deflationary tokenomics will be unsustainable at best because we still need to know what would make good incentives. Today, many only speculate about what and how their on-chain model will bring change. And I actually love this one. It's one of my favorite controversial opinions because I actually agree with it. I think everyone loves deflation. I think the word deflation in crypto is a massive buzzword. I think everyone that hears the word deflation instantly goes, wow, oh my God, deflation, I'm going to make so much money because, it's a supply squeeze. And you hear all these buzzwords, supply squeeze, deflationary. People get really amped up on that narrative. But at the end of the day, you have to remember, why do people get into certain projects? It's to earn money. And how do they earn money? They earn it through yield. They earn it through incentives. So inflation is a way to secure the network via incentivizing people to use the network. And deflation, at its very core, is almost a disincentivization to use a network, because maybe it's a reason to speculate on the network from a buying perspective, but from a usage perspective, from a staking perspective, inflation in many cases is good. And that's why Bitcoin, many people argue, 𝗕𝗏𝗘 included, that an inflationary model would be better for Bitcoin than relying on miners. And that's a whole new discussion, but I think that is a valid concern. And also when it comes to layer ones, you have to ask the question, what happens when their staking rewards run out? Are people still going to stake just to earn fees? Because fees on a lot of chains are very low without usage. And you have to ask yourself, when DeFi emissions run out, there's a lot of DeFi protocols which released with heavy emissions had very aggressive supply schedules, and those cliffs are now nosediving. And the emissions being paid out are now nosediving. And how are those protocols going to prop up those incentives? Well, it's got to be through real revenue now. It's got to be through real yield. And many projects aren't going to be able to generate that without users because they never had users. They just relied on fake users. So I do think deflationary tokenomics have a flaw. I think it works extremely well when your app's being used. It works extremely well when you're a high revenue generating protocol. But they're few and far between. And for many protocols, they're going to need to find new ways to incentivize people to use the chain. And at the end of the day, this comes in terms of user experience. So offering an experience that is pleasurable to use, offering something that's needed and wanted by the market. So I think DEXs are a good example of something that people need. People want to trade. People want to speculate. You need places to speculate on chain. DEXs are going to do very well. But for the protocols that people don't actually want to use or don't really have that fundamental need of using or aren't very enjoyable to use, they're going to struggle as well. So this is a very interesting conversation. And I do think there's issues with deflation, just like there is with inflation. But deflation can be very good. And it can be the reason why a project could 10x. It very well be a reason why Ethereum hits $10,000 one day, deflation. Because if the network's being used and you're getting an insane amount of burn, but the supply is going down, maybe at some point you do hit that kind of elusive supply squeeze point. Maybe you do, but it does rely on the network being used. So you have to remember that. Next one. Bitcoin should be remade to be greener, if that's even possible. You can't remake Bitcoin, but you can choose where you invest. And I think many institutions are now saying, well, Bitcoin's not that green. We have an environmental mandate to our shareholders to do the best by them in terms of our ESG concerns. Let us invest in projects that are more green, like Ethereum, instead of Bitcoin for this reason. And 𝗏𝗃 actually said this. He said in the interview with him that he's seeing many institutions that he talks to, because he's obviously the managing partner at Dragonfly. They do a lot of work with institutions. They, manage capital as well. He's saying that a lot of these institutions now, they're very hesitant to invest in Bitcoin. And he thinks that $1 trillion coin isn't going to come off the back of retail. It's going to come off the back of institutional investment. And when we look at the landscape of institutional investment, ETH is a much more kind of liked idea by institutions because it has much better environmental properties, because it's proof of stake. It isn't relied on. You don't rely on mining, so you don't rely on a crazy amount of emissions to create Ethereum tokens. And 𝗏𝗃 says it's the only game in town if you want institutional buyers. So at the end of the day, I think this is one of the reasons why Ethereum one day could flip Bitcoin, because of the ESG-friendly element. And maybe we do need to reconsider some of Bitcoin's properties. But I think it's not just up to Bitcoin's model, because I think the model works in many ways. I think it's more up to the miners to move towards greener forms of energy. And that is a very political issue, because greener forms of energy are going to come at a cost in the short term, and miners will likely only move across to those forms of energy if they're cheaper than fossil fuels and other forms like coal energy, etc. So when renewable energy becomes cheaper, like it is in some countries, then miners will gravitate towards that. But until then, Ethereum still could be kind of a better proposition for many institutions. 2025 will be the last all-time high. For altcoins, for many altcoins, probably. For 90% of altcoins, probably, because a lot of altcoins, every cycle, most altcoins die, and then there's new ones that come, and then they do well next cycle. But if you talk about Bitcoin, absolutely not, in my opinion. If you talk about Ethereum, absolutely not, in my opinion, because you have to remember why Bitcoin was created. We have a currency problem because currency is being debased ever since we went off the gold standard in 1970 with President Nixon, when they started to print fiat that wasn't backed one-to-one by gold. We have used money printing as a way to get out of sticky economic situations. If there's a war, you print more money. If there is slow economic growth, you print more money. If there's a pandemic, you print more money. And last year or 2020, we saw the money supply double in 1 year, which is absolutely crazy. So ever since we went off the gold standard, we have kind of opened the floodgates for currency debasement. And it's never going to get better. It's only going to get worse and worse and worse over time, in my opinion, as dollars get devalued. So you do need a solution to this problem. And I think Bitcoin is a great solution. Just like gold is a solution, Bitcoin is a digital version of gold. Bitcoin has properties that make it superior to gold in many ways. And I'm an advocate of that argument over gold as well. So I think long term, if you take into account currency debasement, Bitcoin is a big winner. So I don't think 2025 is the last all-time high because I don't think inflation's going anywhere long term. But then there's also two other factors here. The first one is, for many countries, Bitcoin may be the only solution. Because what's happening is, with US interest rates rising, with the US dollar rising in tandem with interest rates, because people now want to put their money in the US to earn yield on it, we're getting a lot of nations that have US denominated debt that are going to have to default on that debt eventually. And because their currency is weakening in US dollar terms, they're not going to be able to pay back that debt. And the problem with that is many smaller countries' currencies are going to collapse. And when they collapse, you're going to need to flee to a safe haven asset. And that safe haven asset, in my opinion, or at least one of them, because you have commodities like, silver and corn and oil, and you've got gold as well as what's viewed as an inflation hedge. But one very good solution is Bitcoin, because it's accessible and it's easy. You can just buy it on an exchange. You can send it to your friend. There's not as much barrier to entry as there is buying gold. Buying physical gold is very difficult. Buying gold shares, there's more of a barrier to entry to that with the paperwork. You need a brokerage account. Smaller countries that are going to feel the effects of the rising interest rates and the rising US dollar, they're not going to be able to always have gold as a solution there. People are going to want to buy things like Bitcoin. So I think Bitcoin comes in for A, currency debasement long term, but B, maybe in the shorter term for a lot of these smaller nations. And then my third point is not related to Bitcoin. It's related to, this does apply to Bitcoin, but Ethereum and a lot of L1s as well. And that's network effect. Network effect is the reason why we're in crypto long term, because we know how exponential growth operates when you have different points all talking to each other on a network. So the more wallets that enter the network, so the more people that enter the network, over time, the more value that network's going to accrue. And as a result, the more value the token's going to accrue. So something like Ethereum really relies on this principle of network effect, and so does Bitcoin as well. So saying 2025 is the last all-time high, it's very, very hard to envision because of the three reasons that I just stated and because of the power of network effect. And that's why I would disagree with that statement. We also have the halving in a year and 20 days, which is something I'm sure a lot of you guys are looking forward to, because that is going to reduce the supply of Bitcoin even further, which makes the supply side even stronger. Quantum hacking of Bitcoin is another controversial opinion. He didn't phrase this very well, but I think what he meant to say was eventually Bitcoin will be quantum hacked. And there is a possibility that happens one day. The thing is, that's very far away from happening. So Bitcoin transactions one day will have a window when they're vulnerable to quantum computers, which means the network could be essentially exploited. But this is not going to happen for a long time. And there is estimates on when this will happen. And it could be thousands of years away. Could be hundreds of years away. We don't really know. But you do need like 1,000 physical qubits for one to kind of exploit the Bitcoin network. And he said it would take 317 million qubits to hack Bitcoin in 1 hour, which is a shit ton. Considering just recently we were at 10 bits, and now I think we're at 100. So there's a long way to go before we arrive at a point where Bitcoin is quantum hacked. So that's not something that I would be worrying about too much. And the last controversial opinion for today that I'll go through is ETH is better than Bitcoin. And we kind of already touched on this. 𝗏𝗡𝗦 said, I guess it's not really controversial in the DeFi space, but overall it is. I'll give you my take on this, just a very short take. I think you've got the ESG argument that 𝗕𝗆𝗫 made, and I agree with. I think for institutions, ETH becomes the main game in town eventually. I think from a tokenomics perspective, because of the ability for the Ethereum to network to gain network effect quicker, because of the use cases you can build on top of it, that will result in more activity, more ETH burnt, and with the reduced ETH issuance now, as we can see, ETH's becoming deflationary. So at some point you get a supply squeeze. I don't know when this will be. Could be 2 years away, could be 3 years away, could be 10 years away. But at some point we genuinely get a supply squeeze, in my opinion. And when this happens, ETH has potential to really go parabolic. And although the same thing could happen with Bitcoin, it's going to take a lot of factors to line up in Bitcoin's favor for that to happen. I don't think those factors are as outlandish on the Ethereum side of things. But the major threat to Ethereum is, I guess, the technological threat of it not having a moat. Bitcoin has a very strong moat. There are ETH competitors, which can definitely eat away its market share. And there are vulnerabilities with the upgrades. To get to the point Ethereum wants to get to, they have to conduct many upgrades. when you're conducting many upgrades, that kind of gives you more points of failure. And Ethereum's tech objectively has more points of failure than Bitcoin, which means there are more inherent risks. So you certainly pay for the risk here. It's not a risk-free trade, ETH versus Bitcoin, but I do think it's a trade from an EV perspective. So if we work out the probability long-term, I think it'll happen, in my opinion. That's subjective. The way you calculate EV is subjective based on your own approach, your own calculations. In crypto, that's just how it works. And in markets, a lot of the time, that's how it works. So yeah, I do think Ethereum long-term does flip Bitcoin, but I think both perform well, and I hold both roughly equally in my portfolio because I have conviction in different areas. I have conviction in Bitcoin as the future of digital gold, and I have conviction in ETH as a decentralized internet that is going to have many awesome dApps built on top of it, and eventually will have a very good user experience built on top of it. So I'll just look through some comments now, kind of maybe go over some of your, for the next couple of minutes, some of your controversial opinions. ESG is not enough. 𝗵𝗏𝗃 keeps running. 𝗵𝗏𝗃 is pumping. But 𝗵𝗏𝗃 is kind of one of them that is, it's pumping based on a lack of liquidity in the short term, I would say. Long term, look, I wouldn't be buying spot 𝗵𝗏𝗃 long term. In fact, eventually, I think it does pull back. I think at some point it'll be a decent short, actually. But right now, you don't want to take that trade. The momentum's too strong. It's going crazy. It's up 44% today. I don't want to toot my own horn too much, but I did tell people to buy spot at $6. And let's see if I have the proof just quickly, because I did buy spot and it's up significantly, but I am taking profits on it. Where's the proof? I need the proof. The video is called I'm Buying 2 Altcoins Now. And I don't really say I'm buying altcoins much, although some of my videos are like, I'm buying these. A lot of the time, like, it'll more be a research video where I'm researching something, and then I'll say, I'm looking into this if it hits this level. This was one of the times where I didn't say if it hits this level. I said I'm aping now. I said I'm buying GNS, and I said I'm buying 𝗵𝗏𝗃 in this video. So that was a good one. GNS and 𝗵𝗏𝗃 on, when was this? October 20th. Since then, 𝗵𝗏𝗃 is up a shit ton, but I don't know exactly how much. It was at $7, so it's like up like 130%. And then GNS on October 20th, probably not up as much, but it did hit $6. It's at $5.78 now. I did call this at $1 on the show, but I want to get the exact amount. On October 20th, it was 287. So rough, like 2.5x. So those were good trades. I'm still in a lot of my GNS bag. I am taking profits. I'm not an idiot. I've gotten my initial out now, so I'm riding risk-free. But this has been an amazing trade. So congrats to everyone that got in on the GNS trade. Remember, their trading comp is live now for $100,000 potentially in prizes that you could win. So sign up using the link in the description to get involved with that. If you do want to trade, and you guys can see my trade here. And then 𝗵𝗏𝗃 as well also performed super well. Miles, thoughts on LSD? Well, the LSD narrative still has relative strength, and it still is quite strong. I would say the strongest ones are probably Frax and Lido. I still have a decent Lido bag. I've got some Frax, been buying DCAing for a while. But what I would say is, like, you would need a decent pullback to get into that narrative because it is quite overbought in the short term, although I still think it has legs to run. So you would need a pullback, and I'm just kind of waiting to see what happens with the market. If we get a more significant pullback, I might add more Lido and more Frax. But the level I'd add more Frax at is, I'll get this up on my chart just quickly for the Frax trade. It's not, get it really quick. There's no data on the pair. Frax, FXS, I'm going to look up. FXS on Binance. Okay. The level I would add more Frax at is the $8 level. It's actually before this flag. It's roughly here. It's roughly here, 822. So we are going to need a pullback. I just think in the short term, it's overextended. Like if we somehow do get down here, maybe I'll buy some more, hoping for a bounce. So that's kind of where I'm seeing Frax. I'm not too keen on, unless you wanted to trade it, trading's very different to kind of a longer term DCA or kind of like a medium term DCA. You could wait for a breakout of the trend here. Very, very weak trend line, but like roughly a breakout, and then you could trade it. But I'm not really interested in trading Frax. There's many other coins we can trade. All right. Hope you guys enjoyed this video. Actually, let me know in the comments. Do you want to see a controversial crypto opinion video again? I think it's a lot of fun because I get to discuss a lot of cool topics that I wouldn't normally discuss. And if you guys want to see it again, I can do this like every 2 weeks or every 3 weeks. I'm sorry for the clickbait. I know the title was bearish and clickbaity, but at the end of the day, it's controversial crypto opinions. So that's kind of just the style of the video. So I think maybe you get the video now that you've actually watched it. But yeah, let me know if I should do it again in the comments. I'll be very interested to hear your guys' opinion on this format. And maybe we even get it edited and make it like quicker and sharper in future instead of doing it live. But I don't know if you want me to do it live again. Just let me know what you think in the comments. I'll see you in the next one. Remember to get involved in that GNS trading comp. And I'll check in tomorrow and see how my trade's going. But until then, I will see you later. Peace out. Have a lovely day.